Welcome, everybody, to this tech special. Tesla reported $3.3 billion in third quarter profit in its highest ever quarterly revenue, but missed analyst sales estimates. We're going to dig into the details and numbers along with Dan Ives, Managing Director of Equity Research of Wedbush Securities. Good morning, Dan, and thank you so much for joining us.
Yeah, great to speak with you.
So Dan, I'd like to kick off with the numbers. What's your first take? From one side, we have record numbers in terms of revenues. On the other side, missing expectations. What's the real issue, in your opinion, and the real reason that the stock is off about 5%?
Yeah, I mean, look, let's just take off the rose-colored glasses. I mean, this was not a phenomenal quarter for Tesla, and it's something that goes against the norm in terms of what we've been used to for the last 2.5, 3 years. So I do think it's supply chain logistics driven, but Tesla's held to a higher standard as well as Musk. And that's why you're seeing the reaction in terms of negative because of margins, deliveries, and we'll call a little tempered forecast for Q4.
So do you think, did Musk actually manage to convince you during the conference call in terms of demand and deliveries for the fourth quarter?
Look, I think demand continues to be pretty robust, despite the macro and what we're seeing with the other automakers. But they're running into some issues, logistics, delivery, and I think around the edges, some demand issues. And that's really going to be the debate here is that, Musk will continue to talk the game and ultimately is really execute in historic fashion. But I'd say right now it's a rough patch for the next 3 to 6 months to navigate Tesla through. That's what investors are focused on. And I think this was definitely not rainbows and roses in terms of an overall quarter.
There are a few details I'd like to dig into. First of all, Musk said something very important. He sees the potential path for Tesla to be worth more than Apple and Saudi Aramco combined. So do you think that actually this statement, which is not even a goal, according to Musk, is actually feasible?
I mean, I want to play in the Premier League. So the point is, like, anyone could say anything, but yeah, I mean, I think that's more. Look, I think it's misguided, and to be honest, I just don't understand why to say something like that. It's just noise creates headlines for a company that just missed deliveries and lowered their forecast for Q4. And I think it's part of the frustration we're seeing. Remember, this is Musk is buying Twitter at $44 billion for an asset that's probably worth $20 billion, overpaying by probably about $25 billion. So I think Musk should stick to his genius in terms of what he does with Tesla, SpaceX, and I think that's probably a misguided statement.
Well, let me ask you, what's your take and actually short to midterm target price for the stock, considering also the fact that probably in 2023 there is going to be a huge buybacks program.
Yeah, well, yeah, I mean, like, this remains one of our favorite names from disruptive tech, $300 price target. I think this is a name that will be able to navigate this rough patch, still in the early innings of a massive growth opportunity. That buyback you're talking about, I do believe probably about a $7 billion buyback. They have $20 billion of cash. I think that's long overdue. So I think we're going to look back at this period as just a blip on the radar. But Musk, as a pilot on the plane, needs to navigate Tesla through it, especially with an EV arms race that's happening globally across Europe, China, as well as the US, and obviously a dark macro.
Look, Dan, I was wondering, in your opinion, the self-driving software of Tesla, do you think this might be a very important revenue contributor in the future? And what's your take on the fact that in 2022, it's not ready yet for approval?
Yeah, it's a great question. And I'd say when you look at the future, FSD, full self-driving, it's one of the keys to the Tesla story. I think it's been overall a black eye moment for Tesla. We've seen a lot of the tragic situations on the FSD front, especially in the US. They're going to need to rectify this. In other words, like, this really needs to, from a software technology perspective, to navigate the speed bumps here to get ultimate approval and really to start to get to level 4, as we go into the next 2 to 3 years, because that's one of the key advantages for Tesla versus other automakers. autonomous FSD. But right now, step by step, it's getting through this path.
Okay, so do you think a regulatory approval in 2023 when it comes to the self-driving software of Tesla could be a game changer for the company?
I think it's one of the keys that they need to get through, because ultimately that continues to be a battle versus the regulatory authorities for good reason in terms of what they've done in the FSA. And I think Musk and Tesla knows there's definitely wood to chop there, and they need to get through this. And I do believe they will ultimately get approval. And that's one of those key sort of targets, along with deliveries, production, China, that they need to get to.
Dan, let me just ask you, what do you think about Netflix numbers? We are right in the midst of tech earnings, so this is extremely important moment for markets. We might see a lot of volatility. We saw Netflix surging more than 15% in the past 2 days. So I was wondering, do you think this is some kind of beginning of a positive narrative for Netflix?
I think it finally has started to get to a point that they've gotten their arms around some of their growth issues. And I think this quarter step in the right direction. You got the ad service coming out as well. I mean, look, they had a growth overhang post-COVID, and now navigating through that. And I think for Netflix and for overall tech, it was a positive start to earnings season. But look, with that said, I mean, streaming, extremely competitive. You're starting to see more saturation in the market, and especially consumers feel more of a pinch in their pocketbooks and wallets. That monthly subscription, you could see more and more churn. So that's why I think this is an important moment for Netflix, and this was, clearly a positive sign in terms of what you want to see on the Netflix story.
And what do you think are going to be the major challenges for the company and the rest of the streaming services in 2023 and in the future in general?
I think it's content's key, and obviously Netflix is in a phenomenal position there from a content. But investors recognize the average home has 3 to 4 streaming services, and they're going to start to make some tough decisions. So, Netflix, that's why you need other lower price points, other sort of packages. Churn's going to be an issue, but it ultimately, content's king. Need to keep coming out with great content to feed the machine. International growth is obviously going to be the focus in terms of subscribers, but this is a Game of Thrones battle. I mean, you look at Amazon, you look at Disney, you look at Hulu, obviously you look at Apple and others. It's going to start to, clearly take hold over the coming year.
And final take on tech sector in general, we are living in a probably challenging time for tech stocks. From one side, of course, we have the Fed. For several banks now, the terminal rate is moving from 4 point something to 5.2%. And on the other side, possible recession in 2023. So what does this mean for the tech sector in terms of performance, market performance?
Well, I mean, it's been a risk off. It's been a disaster this year. Just given the Fed, the war path on rates, what we're seeing with inflation, geopolitical. But I mean, as someone that's covered tech through multiple cycles going back to 899, I view it as a period of time where, Street's going to look past this period. You got to focus on some of the high quality stalwarts like a Microsoft and cloud, like an Apple, like a Google, cybersecurity. So I think there's pockets you want to own, to get through this. But no, look, it's going to be a roller coaster ride, because right now the backdrop is anti-tech. That's why this is, I believe, one of the most important earnings season in the last few years for tech. Netflix kicked it off positive, but this is really going to define, I think, where tech goes for the rest of the year.
And final takes. So do you think we're going to see a better environment for tech sector in the long term?
Yeah, I think we are starting to see light at the end of the tunnel. Given the valuations, I think fundamental stocks are baking in a lot of bad news, but I don't think that light's an oncoming train. I think we're starting to get to a point that tech will start to see green screens as we go into later this year into next year, because these are disruptive themes that are not going away. Cloud, EV, 5G, some of the smartphone technology. I think chip sector is way oversold as well. And it's as bearish as I've seen, probably going back 2008 in terms of my investor conversations.
So we can say that the worst is already priced in.
Look, I mean, I believe that we bottomed. I believe the worst is in the rearview mirror. We're in a bottoming process, and we look back at this period as a time to own these names rather than throw in the towel and go into the basements fearing worse things are coming.
Thank you very much. Dan Ives,
Thank you.
Managing Director, Equity Research, Wedbush Securities. Thanks for joining us. Have a great day.
You too.